Welcome to the world of accounting. I thought we would start today's class by reviewing some of the nitty-gritty, all the crap that's going on, because we have a lot of different things to keep track of early on in this class. First of all, someone called and said they couldn't get the textbook. Now, my question is, has anyone else had that problem? They can't get the textbook. Anyone who's viewing this over the wire? Okay. I guess my reaction to that is I think textbooks are available through Total Info or on campus here through the RPI bookstore. So that if you haven't tried both of those outlets to get a copy of the textbook, that's what I would do, because I think they are available. Now, one of the things that we did in this class was we recommended using the solutions manual to the textbook. And it turns out that McGraw-Hill doesn't have many of those solution manuals. And so, you may have difficulty getting access to the solutions manual. Now, what I want you to understand is that the only reason I made the solutions manual mandatory or required, because I do not think it should be required, the only reason it is required is because some people in prior years have wanted to get the solutions manual. And if it's listed as optional, their companies will not reimburse them for the book. So my suggestion to you is that if you know someone who has one, and if you're on campus, we have some on reserve in the library, and we have some on reserve here and there, you do not need to have one of these solution manuals, because the solutions to the questions in the book, frankly, the questions are really easy. You're not going to need a solutions manual. What you need to concentrate on in this class is not the problems in the book. That's the intermediate, or call it the first step. But what you need to concentrate on are the problems from the problem sets. And you're probably saying, well, what problem sets, Bob? And so, I went to the website right before I came over to class. And what indeed, I couldn't find them either. So I talked to Eleanor Cupp, who's who's taking care of all that stuff. She promises me the problem sets, the two you will need initially are problem sets 1 and 5. She promises they will be up tomorrow or the next day. So you will be able to get problem sets 1 and 5 and problem sets 1 and 5 answers, and they will be up fairly soon. Now, one thing that I can't remember whether I mentioned last time is that this past summer what I did was I videotaped me creating solutions to problem sets 1 through 6. And right now, the tape for problem set 1, the tape for problem set 2, and they're working on the tape for problem set 5 are all in the process of being video streamed. And we hope to have them up on, we hope to have at least problem set number 1 tape, video streamed, and available by the end of the week. So that will help you, because what you're going to find, and what students every year have found, is they go to problem set number 1, and the first 10 questions are fairly easy, like the questions in the back of the book, and they go, no problem. They get to problem 11, and they go, Well, please understand, the questions from old exams are tricky. It's going to take you a while to get used to them. That's why I give you both the questions and the answers and me solving these things, just so you can see me do it in action. And then hopefully you can take that knowledge and apply them to old exams, which you will not get the answers to, but you'll be able to find a question on a problem set very similar to the questions from old exams, and you can practice and work through those things that way. So, I mean, just so you understand my rationale and the method to my madness. So what you will have, let me review again, by the end of the week you should have problem sets number 1 and number 5 and their answers on the website, and the video streamed Boylan's solution, right, to problem set number 1 by the end of the week. And your job is to start working on these questions. Now, to be honest with you, you won't have enough material to truly do the whole problem set until the end of class, maybe next week, maybe the week after, because there's just a lot of information that's covered in problem set number 1. It's the first 3 or 4 weeks of the semester. So, you know, if you're going through them and you don't get them all right now, that's okay, because we haven't covered all the material quite yet. But in any case, I wanted you to have an update that stuff was, in fact, it is, you know, it's going to be available, and the old exams will also be available in short order. That stuff's all in the works. Now, last time I said we ought to make more concrete the date for the exams, and I got a lot of feedback from students both on campus and off, and everybody hates the idea of having the midterm exam before spring break. And the reason is because other people have other exams that week. And so the midterm exam right now is scheduled for live students on Monday, March 19th. And that is Monday after spring break. Okay, just so you know. And that's 2 days after St. Patty's Day. So you have all Sunday to go from being green to that cute pink I'm seeing in all these faces in front of me right now. Also, the project number 1. Project number 1, we want to have due Thursday of the week before. In other words, I want you to do project number 1 because that will help you to understand the material in studying for the midterm exam. And I also want to get it to me in time so I can take it with me because I'm going on spring break as well. So I'd like them to arrive on or before Thursday, 3/8/2001. And this is, and you should email this stuff to me. And actually, you're not going to email it to me, you're going to email it to one of the TAs, and we'll work that out a little bit later. But I wanted to make sure we had all these things emailed to us before spring break started, so we'd be able to have get all that graded on or about when you're taking the exam, just so you can get some feedback in a hurry. Now, there are 4 requirements to this course. We now have dates for 2 of them. The final exam, I don't know when the final exam is going to be given. But I am pretty sure it's going to be given during Monday of final exam week. So I don't know when that is off the top of my head, but I am reasonably sure that Monday of final exam week, that night, is when the final exam will be. So if you're marking your calendars, make sure you aren't traveling, or if you have any discretion, make sure that date is free. The last to do is project number 2. And for project number 2, I want that due the Wednesday of the last exam of the last class week. And so we'll have our last class on Monday. Then you'll be able to take that material from Monday, have Tuesday and Wednesday, and then submit the final project. And that turns out to be, what did we say that was? That was 4/25. Wednesday's the 25th? Yeah. So let's make that Thursday, just to give you another day. So Thursday, the 26th of April, 2001, is the due date. Again, and you can email these things to probably one of the TAs, will be the due date for project number 2. So now we have hard dates for all 4 of the deliverables for this class. Any questions about that? Now, those of you who are viewing this tape delay, the usual convention, as I'm sure you know, is that you will be taking it with a 1-week delay. So, for instance, the project for you would be due on the 15th, 7 days after the 8th, and et cetera. So that's, just So there's no doubt about that. These are the due dates for the live students. Those of you seeing a tape delay, you have, as I understand it, a 1-week leeway, and that is what the convention has always been. Any questions? Any questions from anybody, either on the wire or in class, about what's going on in the class, where the stuff is? It's Srini, right?
Srini, yes.
Srini.
Can I question on this problem sets? How is the problem set 1 relates to chapters 1, 2, 3, 4, 5? Is there a relation, or like is it there?
At the top of the problem set are the topics that are covered in the problem set. Now it's related more to the note topics than to the textbook chapters. So, but I will try to make that very clear. Okay. So good point. I mean, good question. When you see the problem sets, it can sometimes be a little bit vague as to what is being covered in each one of these problem sets. And I'll try to make that a little more clean for you in class. But what I can tell you right now is that problem set number 1, which is what you need to focus on, because it's probably the trickiest one, especially at the beginning, is going to cover the material for the first 4 classes or so. So, that's where you want to focus your time. And then problem set number 5, one of the next topics we're going to be doing is a thing called present values. And problem set number 5 is the problem set on present values. So problem set number 1 and then problem set number 5 are going to be the 2 problem sets that you want to focus on for the first, like I say, 4 weeks. Question?
Are you aware of any problems with viewing the lecture 1 on the website?
So you're talking about any problems with viewing over video streaming?
Yeah. Are you aware of any?
I'm not aware of any. Lord knows I've had some trying to view it myself. But I don't. You're really asking me, am I aware of any solutions? I think is what you're asking me. And the answer is absolutely not.
Okay.
What's your problem?
It won't open.
It doesn't open at all. I guess the person I would email about that is Eleanor Cupp. And you have her, it's CUPPE at rpi.edu. And that's where I would start. And she will bing you to whoever can answer that particular question. You got into the website okay, everything else worked okay, but it just wouldn't come up.
Right.
And you were viewing it from where? On campus or from home?
Home.
AOL or something like that?
Roadrunner.
Roadrunner. Okay, I don't know if there's a Roadrunner problem specifically, but hopefully Eleanor can help you with that. Okay. Any other questions? So a quick review.
I'm sorry. The project number 1, is that going to be on the website as far as?
It will be on the website by next class. I, in fact, have that work in process. I'm debating how clever to make this particular project at the moment. I'm updating last year's project to make it a little bit more interesting. But it's very similar to last year's project. Yeah. So it really is not a difficult project. It's an Excel-based project where you're forecasting financial statements. This is not a big deal. Yeah. Any other questions? Okay, let's do a quick review of what we did last time. Because remember, I'm assuming. Is there a question from off campus? Someone's looking at her monitor like she hates it. Last time.
I have a question in San Jose.
Okay, San Jose, go ahead.
I'm just as a clarification, so we have these problem sets, we have the homework assignments, we have 2 projects, and then we have the tests, correct?
Correct.
And the problem set and the homework we do not hand in.
Correct. In fact, the only thing that gets handed in are the 2 projects and the 2 exams. That's all. You only hand in 4 things. All the problem sets are there for you to work through, but I'm not going to collect or mark. In fact, I'm giving you the answers to all those things. Right? So the questions.
Are the homework assignments the problem sets, or are they different?
There are questions assigned from the textbook as well.
Okay.
Okay. So your homework is. I guess one of the next questions is if I were a student, what would I be doing if I were you? Right? That's a question that I think you should be thinking about right now. Okay. I have taught this class probably 50 times over 20 years. And my suggestion to you is, first of all, don't read the textbook. So if you want Boylan's suggestion for how to do well in this class, suggestion number 1 is do not read the textbook unless you have to. Suggestion number 2 is, if you've never done accounting in the past, the place to start with respect to problem solving is to start in the textbook with the easy questions that happen at the end of the chapters. And if you can do a couple of them and they seem easy, then don't spend much time on those questions. Go right from there to the questions in the problem sets, and spend more of your time on the questions in the problem sets. So the gist of this is that you want to be spending your time doing the questions from the problem sets, because that is what you're going to be graded on. That, in my opinion, is the best way to understand how accounting really works. To work through the relationships that are forced upon you by solving the questions in the problem sets. Now, if what we're doing in class didn't make sense to you, or I'm using terminology that you just have never heard. I mean, for instance, if you are an engineer, never did anything in business, you've been in a lab your whole life, you're walking into accounting, you've never heard of assets or equipment, if those terms are completely alien to you, then it makes sense that you should go and start reading the textbook, because there's a lot of terminology up front that is stuff you just absolutely have to have. Now, once that terminology becomes familiar, the next question is, and what you're going to be tested on is, can you use that information? So my opinion is that you want to be able to use the information. I'm never going to ask you a definition. I'm never going to ask you multiple guesses. Every question you get from me is going to be problem solving or problem solving with a short essay to describe what you did. So, I mean, everything you get from me is going to force you to use the information that we're developing in class. That's how you're going to be graded. Now, someone asked, speaking of the exams, are you going to have the full 3 hours for the midterm exam? And the answer is sure, you can have 3 hours. That's fine with me. The second question was, is it open book? And the answer is definitely not. So both the midterm and the final exam are closed book, closed notes, closed mouth, no collaboration exams. Okay? And that, again, for people who are in class, that may sound like redundant, but if you're off campus and you're taking it alone in some business building, please understand. The deal between us is that this is a closed book, closed note, and that way I make questions up that I think should look familiar if you did your work. Right? If we have an open book exam, suddenly the questions get much more difficult, and you all don't want that, believe me. Anything else? Yes.
Question, Professor. If there's no textbook, so the only material which we can read is your notes, am I right?
No, there is a textbook.
Yeah, if we don't want to use a textbook, the material that we have to read is only
That's
notes.
right.
And if we can read the notes, we can survive. If we know the basic terminology.
Survive would be a good way to put that, yes. You can survive with the notes. In fact, many people have not bought the textbook and gotten A's in the class. Because what I teach comes from my notes and the problem sets. And that to me is what's important. But the textbook, particularly if someone else is buying it for you, is a great investment. Okay?
I learned this last week.
Any other questions?
Are you going to take home parts to the midterm of fun?
No, I've done that in the past, and this time I do it different every year, and this time I'm not going to have a take-home part. It's going to be, come here, good luck. 3 hours, right? I'm going to try to design an hour and a half exam, but give you 3 hours. So there should be, for instance, the midterm exam is going to be 10 questions, the final exam will probably be 14 questions. Similar questions. So you should have, most people will finish the midterm exam in an hour and a half. But that gives you time to get up and walk around and go think about things and do whatever. So there should be no time constraint on the midterm exam.
Do we use a computer or?
Oh, can you use a computer? And the answer is, I encourage you to use a computer. what I will be doing in class, and in fact, from this point forward, I encourage you to bring your computer to class. Now, this is one of those nice classes where you can't hook up to the internet. That means no one's going to be playing games with their buddies or writing notes or things like that, you know, or their email. But what I will be doing in class is I will be using Excel. And so my suggestion to you is to use Excel to solve problems. And so, you know, you cannot access your notes on your computer. If I see that, oh, boo-how. Very bad. Right? Very bad. But other than that, to use Excel to do present value problems, to use Excel as a calculator, to use Excel to solve, I mean, you can create your own worksheets as long as they're blank to help you solve problems. That's fine with me. I mean, I'm going to encourage you to use Excel at every instance you can possibly use it. And any of that stuff that you create, right, that doesn't have any numbers in it, right, but if you create blank forms that will help you solve the questions in the problem sets, you're welcome to bring them up and use them on the exam. So not only do I say it's okay, I encourage you with every ounce of my soul to use your computer on everything we do in this class. Anything else? Okay, what did we do last time? Quick review of what we did last time. We did the basics of accounting. And the basics are as basic can get. We started with 2 questions. Question number 1 is, what type of an account is it? And what are our options? There are 3. There are assets, liabilities, and equity accounts. So question number 1, and all we did last time was record information. What type of an account is it? You need to be able to recognize asset accounts, you need to be able to recognize liability accounts, and you need to be able to recognize equity accounts. Now, what's tricky in that particular equation? And the answer is, the tricky part is under the equity portion. The tricky part is, in fact, there's a thing called retained earnings as part of the equity accounts. Now, retained earnings we talked about last time is what? Retained earnings is simply the summation from all prior years, from period 0 to today, we'll call that T, of all prior years' net incomes less all prior years' dividends. Now, if net income is a retained earnings account, which is then an equity account, then anything that contributes to net income is also a retained earnings type account and an equity account. Well, how do we calculate net income? Net income is revenue less expenses. So what does that mean? That means that every revenue account and every expense account flows into net income, is a retained earnings type of account, and is therefore an equity account. Okay? And that's the tricky part, is to understand how retained earnings, which really comes off of the income statement, affects the balance sheet. Because the balance sheet, in effect, is assets equal liabilities plus equity, right? That's our format for the balance sheet. Back to 2 questions. First question is, what type of an account is it? What's the second question? Nope.
How did it change?
How did it change? So the second question is, once you identify what type of an account it is, how did it change? And in gauging how it changed, you have to keep in mind what? That the accounting equation has to always balance. So anytime you record information, you have to record it in a way that the accounting equation always balances. Now, what that means, right, a very simple transformation of that basic accounting equation is that all debits must be equal to all credits in terms of our journal entries. Debits being equal to credits is exactly the same as assets must be equal to liabilities plus equity. It means exactly the same thing. So what we did last time was we took a large number of examples and showed how to journalize all of those transactions or adjustments. Now wait a second. What's the difference between a transaction and an adjustment? And what do accountants do anyway? Think about that for a second. What do accountants do? Oh, I'm getting in trouble here. I have to label these things. What do accountants do? Well, what accountants do is they create financial statements. Basically, you create reports. You use accounting information to create reports. Now, the process for creating those reports is during the year there are transactions. What's an example of a transaction? How about Nate? What's an example of a transaction?
Buying a business truck.
You buy a truck, you buy inventory, you sell something. These are all transactions, right? Many of them involve cash, but not necessarily. You could buy something on credit, in which case cash didn't go out or come in, yet it would still be a transaction. Now, at the end of the year, or the end of the period, right? Could be the quarter, could be the week, could be the day. At the end of the period, what do you do? And we're going to call this 12/31 for the end of the year, because virtually all companies have a yearly financial process. And the first thing is they summarize. And by summarizing, all I do is I take a look at all the debits and make sure they're equal to all the credits. And that summary is called a trial balance. And the next thing they do is they create what are called adjustments. What are examples of adjustments? What's meant by that? How about Dave? What's an adjustment?
The one example that we had was wages that were earned yet not paid in the fiscal year.
Okay, we use, and this is a new term, this is today's term, right? This is what today's class is about. We use what's called accrual-based accounting policies. And don't confuse accrual with C-R-U-E-L, right? That's not the accrual we're talking about, right? We're using accrual, and the notion of accrual means that we try to match revenues to the period in which we earn them. We try to match expenses to the period in which we incur them, and that may be different than when the cash moves. So we need to distinguish between two types of accounting. One, cash basis accounting, which simply is when the cash goes out, it's an expense, when the cash comes in, it's a revenue. And accrual basis accounting, which means we recognize the revenue when we earn it, which may be different than when we actually get the cash. And we'll see examples of how we do this accounting as the class progresses. But in any case, this accrual basis nature is why we do these adjustments every year. In general, most of them are based on the accrual-based process. Now, once we do the adjustments, we create another summary thing called an adjusted trial balance. TV is trial balance, right? Same thing as up there. And the adjusted trial balance is the same thing. It's simply a list of all the debits and all the credits, except for now it includes the adjustments that we have made for the period. After we do that, then what we did last time was we created our financial statements, right? And the financial statements, F/S, financial statements, and again, I know I'm abbreviating, but hopefully this terminology is not too alien, since this is now the second class. We talked about two financial statements, one being the income statement, the second being the balance sheet. So I/S income statement, the second being the balance sheet. The income statement, again, simply what? Revenue minus expenses. The balance sheet, what's that again? Assets equal liabilities plus equity. Questions about that stuff from last time? Y'all have done some homework, right? And y'all practiced doing journal entries, right? I can tell by the faces in here, everyone's shaking their head going, oh my God, I hope he doesn't call on me. So we go from here to Chapter 2. So in the notes, I'm going to Chapter 2. But again, before we start, are there any questions? Are there any questions? In Chapter 2 we talk about cost and expense. So Chapter 2 is the expense side on the income statement. Chapter 3 is going to be the revenue side on the income statement. So we're going to start out talking about expenses because they're a little bit easier. Then we'll do revenues toward the end of the class once we get some practice and get these journal entries down again and do all that kind of stuff. Okay. Let's see. In the notes, where am I? I'm on page 2-2. So if you would take me to the monitor, please. We have two models, basically, for cost and expense. The first of which is to understand that a cost is not an expense. The cost is what we paid for something. Now, one model has us taking the cost and calling it an expense right away. And that's kind of like being on the cash basis. Now, the second model that we need to talk about is a situation where we first incur a cost, then we capitalize. Let's see. No, never mind. We capitalize that cost, which means what? We convert it into an asset, and that's all that means. So if we capitalize a cost, all it means is we convert that cost into an asset. Now, once we have called it an asset, it then becomes an expense, but it becomes an expense down the road. Not immediately like we did in example number 1, but the expense becomes an expense down the road. Now, in the example we did last time, one example of this is prepaid insurance. We purchased prepaid insurance, and we capitalized that insurance into an asset, again, prepaid insurance. Then at the end of the year, through an adjustment, we recognized that portion of the asset that had been used up as of year end and recognized the expense. We also hopefully remember that only part of the asset value became an expense. We prorated the asset value based on the metric. In this case, the metric was time. Questions? Another example that we did last time was we incur a cost for a fixed asset. We record that asset on our books. We capitalize the asset on our books. And then we depreciate that asset over, and I guess the example last time was, I think, 10 years. So in that case, we have a long-term asset that we allocate over 10 years. We recognize depreciation expense over a 10-year time period. Questions about that? Okay. So the idea of cost is what? Simply the amount that we paid for something. And in the notes, again, I'm on page 2. An expense, this is the tricky part, right? What is an expense? An expense, the basic idea is that it's an asset whose value has been used up. For instance, when you buy, if you come off the screen, please. And okay, don't come off the screen. When you buy insurance, you buy a 1-year or maybe a 2-year policy for insurance. Now, why do you buy insurance? And the answer is you buy insurance as risk avoidance kind of policy. Now, this risk avoidance thing has a metric, and the insurance wears out over time. So that what happens is, as of the end of the year, you recognize the amount of the asset that has worn out, which is what we did in class last time. Similarly, we have an asset called a piece of equipment. We expected the last 10 years, purely a guess, right? If it lasts 10 years, then we allocate the cost to an expense over our best guess about how long that asset will last. Again, that guess being 10 years. So we chunk this thing into 10 separate parts, and we expense 1/10 of this asset every year based on our estimate. Questions? Okay.
I actually have a question.
Sure.
The prepaid insurance, is that just a unique example that we bought it in March and we were doing the accounting cycle as of December 31st? Whereas if we bought a one-year policy on January 1st of the year, it would just be an expense because by the end of the accounting cycle it's all used up?
If we had purchased the policy on January 1st and it were a one-year policy, then it would have been all used up. So in that case, you might be tempted initially to just record it as an expense. But that technically would not be accurate because if you made up quarterly financial statements, right? Now again, every firm makes up quarterly financial statements, right? So the first quarter's income statement should only have 1 quarter of the insurance expense because you bought a one-year policy. So what should happen appropriately is if you bought it on January 1st, even though you know it's going to be an expense by December 31st, you still record it as an asset, and then you allocate it to however many periods that you would be creating financial statements for during the year. Is that?
Yes.
Okay. Okay. Where am I? I am in the notes. I'm moving to page 6. If you would take me to the computer screen, please. So on page 6, and what's on the computer screen here is the basic model that we just looked at, right, where we have something going on, right? We incur a cost. That cost is capitalized into an asset, and that asset then becomes an expense over time. So we have, in this case, 2 short-term kinds of assets that turn into expense, and then some long-term assets that become expenses. The first thing we want to talk about is inventory. Because inventory is different from virtually every other expense that we will incur. And we purchase inventory, and then that inventory becomes an expense, becomes an expense over time. Except for, what's the metric that we use to recognize the expense? Now, for prepaid insurance, the metric is what? Is time. For prepaid rent, the metric is time. For fixed assets, depreciation is based on time. What's the metric for inventory?
Units.
Stock.
Savings. And the answer is, we do not recognize that expense until we actually sell the unit. So when we buy inventory items or we produce inventory items, it doesn't become an expense until when? Until we sell the item. Now, in particular, it doesn't become an expense until title passes. So if you come off the screen for a second. So what's going on is when a company sells something, right, when does that thing actually become an expense? And the answer is not until it ships, right? And the key thing here is when title passes. Now, it may seem like I'm bothering you with details that you just don't want to know, but this turns out to be very important in terms of management, because there's always an issue, right? If we're shipping it from our factory and it's going over some carrier to their factory, right? What's always the issue if something happens to the inventory? Who owns it if it gets broken right there, right? And the person who owns it if it gets broken right there depends upon what? Depends upon the contract. So the moral to the story is to write efficient contracts, because if you are selling it and we're going this way, you want to make sure title passes where? as soon as it leaves your dock, right? Because from a legal perspective, if title doesn't pass until it gets to their dock, then you own it and you incur the liability for transportation. Now, having said that, anyone who's in business understands that the last thing in the world your customer wants to do is what? The last thing they want to do is own it during the shipping portion. So the terms of sale are going to determine when you recognize that expense. Does that make sense? Okay. If we would go back to the screen for a second.
Actually, when we realize or earn the revenue, when we take
Okay, when we make a sale, we have two transactions that we're going to record. We're going to record the revenue transaction and the expense transaction.
That's right.
But neither one of them can happen until title passes. Right? We don't recognize the revenue until title passes. We can't recognize the expense until we make the sale.
Right.
So they both happen when title passes.
Yeah.
Does that my answer your question?
Yeah.
Okay. Dave?
When we're talking about inventory, do we differentiate between raw material inventory and finished goods inventory?
Okay. So Dave's question, if you can come off the screen, you can come off the computer for a second. Dave's question is, do we differentiate between raw material and finished goods inventory? And the answer is yes, indeed. In fact, to make it a little more fine, what's going to happen is we're going to have various raw material inventories. And I think of someone making bicycles, for instance. You're going to have raw steel. You're going to have all manner of inventory parts, right? And then the raw materials go into an account called work in process. Or sometimes called WIP, work in process, which is a separate inventory account. So we could have thousands of raw material accounts, and each one would have its own account. Each one would be an inventory account. It goes into work in process, which is a separate inventory account, and then it goes into an account called finished goods, which is a third type of an inventory account. Now, the inventory that we've been dealing with so far is only the finished goods inventory in the first chapter. But your intuition is exactly right. We keep track assiduously of all the materials, everything that we put into production, and finished goods as well. And all these inventory items would then get aggregated and shown in inventory on our balance sheet. Maybe in two line items, two accounts, maybe in one, depending upon the magnitude of raw materials and work in process. Am I answering your question?
Then I have another question then. If you're dealing exclusively with finished goods when we're referring to inventory at the moment, and you say there's no expenses really incurred until it ships from your dock, aren't there some sort of expenses incurred in making that finished good?
Oh, there are costs incurred in making that good. But that cost doesn't become an expense, and this is the key difference, so it's a really good question. That cost does not become an expense, and an expense is what? What we record on the income statement. That cost doesn't become an expense until title passes, right? So in other words, when raw material gets transferred from raw material into work in process, we transfer it from one inventory account to a separate inventory account, right? And then it gets moved from work in process to finished goods. We transfer it from one inventory account called work in process to another one called finished goods. But at this point, we have not had an impact on the income statement. Only balance sheet accounts, all of them being inventory. Now, when we sell this item, suddenly we have an impact on the P&L. And you'll often hear business people talk about what's the bottom line, right? Now, what's meant by the bottom line? What's the lowest line item on the income statement? Net income. So if you've ever heard, get to the bottom line, it's an accounting term called net income. That's the bottom line, which is the net effect of all revenues, that's all expenses. So the P&L is the what? The profit and loss, right? So you'll often hear management talk about, do you have P&L responsibility? Which means, do you have responsibility over profit and loss over a division or a company or a unit or whatever, right? So all this material, all this terminology comes directly out of the accounting that we're doing here. And the key thing is, when does it have an effect on P&L? And that's what accrual-based policies are all about. And so, that is, when do we recognize the expense or the revenue? And that's when title passes with inventory. Questions? Okay. Back to the screen, please. The expenses here. So inventory when title passes, prepaid expenses, the metric is time. Very simple, we simply allocate it over time. Now technically, we should allocate it on a daily basis to be more accurate. But in this class, and we should do the same thing with things like fixed assets, like depreciation. For instance, technically if you bought it on January 15th, you should record depreciation for 350 days. In this class, I'm going to assume that anyone can prorate. So as far as I'm concerned, no matter when you buy something in this class, take a full year's depreciation on it in the first year, because I know you can all add and subtract. And it's a triviality in accounting, although one that we usually follow to be accurate and things like that. So when you're doing the problems from the problem set, sometimes they're going to want you to allocate depreciation over 1 year or the next and take 3 months in the first year. And on exams or anything that I have you do for me in class, I'm going to ignore, you should understand that's what happens, but I'm going to, it's just not that important in accounting. It doesn't help you understand really what's going on. So take a full year's depreciation is the moral to the story. Questions? Back to the computer screen, please. The long-term assets. What we've talked about so far is this one asset called the fixed asset. Property, plant, and equipment. And when that becomes an expense, it's called what? Depreciation. Or more specifically, depreciation expense. However, is that the only long-lived or non-current asset? And the answer is no. We also have intangible assets. What are examples of intangible assets? Copyright. Okay, copyright is one.
Goodwill.
Goodwill is another. Whatever that is. Patents.
CRD expense.
What's that?
CRD expense.
CRD. What's CRD?
Oh, RD, sorry.
Research and development. Research and development, not really.
No.
Turns out we do something special with research and development. But copyrights, trademarks, patents, goodwill, organizational costs, when the firm is first starting, things like that become intangible assets. And the key thing here is that this intangible asset, when it becomes an expense, we amortize it, or amortization. It means exactly the same thing as depreciations, calculated the same way as depreciation. We simply divide by 10 and run it through. But we use a different term. And the term, again, is amortization. Now, we can have separate long-lived assets, like natural resources. What are examples of natural resources?
Lumber.
You have a timber stand, right? The trees that are growing on your timber stand are a natural resource, and when you sell that stuff, right, we call that depletion. So here's another example with natural resources, similar to inventory, where with natural resources we usually deplete that natural resource based on units extracted. For instance, we have an oil well. You allocate the cost of the oil well based on the units, the barrels of oil that you pull out of the ground, or the trees that you cut down, or depending upon whatever that natural asset is. Questions about that? Let's do a few examples. Let's see. Prepaid expenses, which one? Where are we now? Same example. Oh, come on. The computer's not agreeing with me here. I'm having computer problems here. Okay. In the notes, I am on page, the insurance example. And the insurance example, I think, is on page 6, perhaps? 7? Okay, on page 7. So on page 7, we have an example where a firm is buying two types of insurance. It's buying casualty insurance, and in accounting you need to keep track of the dates, right? So the casualty insurance we buy on April Fool's Day. Good day to buy insurance. And so it's going to last till March 31st of the next year. For liability insurance, we buy it on June 1st. Therefore, it goes to May 31st the next year. The premiums, $48 and $72. So your job is to record all these transactions. Now, the first transaction we're going to record is to aggregate, even though they bought them at different times, technically the firm would have made two entries, one each time they actually bought this insurance. But I'm going to aggregate them together, and I'm going to increase an asset called prepaid insurance, and I'm going to decrease an asset called cash. Why? Because we paid these things in cash. Questions about that? Okay. At the end of the year, using accrual basis accounting policies, right, we allocate the amount of that asset that was used up during the year. Now, for the year, the total expense that was used up is going to be $7,800, and the calculation looks like this. The casualty insurance, when did we buy casualty again? April Fool's Day, right? So we had it 9/12 of the year. 9/12 times the amount we paid, $4,800, gives us $3,600. Liability, we bought it on June 1st, therefore we owned it for 7 of the 12 months. 7/12 times 72, $4,200. Total $7,800. So let's go back to the entry again. Debit, decrease in equity account, and it's a retained earnings type of account, right? Call that insurance expense. So the total amount, this adjustment, $7,800, and decrease the asset, prepaid insurance, for $7,800. Questions about that?
When you enter it, when you first purchase it, you're entering it in at separate times, obviously.
Yes.
Then quarterly, you then combine them when you're doing your statements?
As of the end of the year, you would just, that's right.
But quarterly, you're still keeping them separate?
At the end of the first quarter, prepaid insurance would only have been the amount from the first policy.
Right.
And at the end of the second, prepaid insurance would have been larger if they did not expense some during the first quarter. Am I answering your question?
Yeah, but at the end of the year, you would put what's on number 2, correct?
At the end of the year, you would, the total expense recognized during the year would be the amount in number 2. That's right. Is that? Yeah. Okay. Okay. If we go to the screen for a second. So what we just did was we showed you how to do the journal entries. Now I'm going to use T accounts to show exactly the same thing. Notice T accounts. In asset cash, we debit, increase cash, credit, decrease cash. And what we did initially was we debited an account called prepaid insurance, and we credited an account called cash. Cash went down by $12,000. Insurance, the asset, increased by $12,000. Now, at the end of the year, what we're doing is we're creating an adjusting entry, call it entry number 2, where we're decreasing the asset by $7,800 and recognizing an expense. And notice an expense is a decrease in an equity, a retained earnings type account. We're debiting an expense account for $7,800. Now, here's my point. In terms of what you're doing, you can when you're recording these journal entries, you can record them either in journal entry form or in T account form. Either way, as far as I'm concerned, it means exactly the same thing. And what you're going to find that I do a lot in class is I will use these T accounts to record information. Because T accounts give me what happened at the beginning, what happened at the end, and I just find T accounts to be a much easier way to show the history of what was going on. There's a question.
Yeah, if assets equals liabilities plus equity, and cash is an asset, and insurance expense is an equity, where does the prepaid insurance fall? What is that? What type of account is that?
Prepaid insurance is an asset account.
An asset.
if you go to the screen, excuse me, if you go to the screen for me, notice assets account, debits increase it, credits decrease it. And so what we did initially was we paid for something that had value to us. And things that have value to us we call assets. So we paid for prepaid insurance, and that then became an asset. We capitalized that cost into an asset called prepaid insurance. And at the end of the year, we adjusted it to recognize that of the $12,000 in the asset, $7,800 had been used up. Okay? Questions? So as of the end of the year, right, the balance in prepaid insurance will be $4,200. Questions? The next year, we use up the balance of it, and the entry is debit decrease in the equity account insurance expense for the remaining amount, which would happen as of the 31st of March, and then reduce prepaid insurance by, again, the $4,200. Those were the entries last year. This year's entry is, again, we can show it up here, entry number 3, debit the expense account for $4,200, insurance expense, credit prepaid insurance, $4,200, giving us our ending balance at the end of 0. Questions? Now,
Did you put the dates? Or do you add the dates on these T accounts at any time?
On the T accounts, do you add dates? And the answer is I don't, generally speaking. I just keep track of the information. I mean, if we were keeping track of all this by computer, the computer would keep track of the date. And in fact, every accounting system in general, the dates are tracked, but not by human hand, but by computer. What question?
The close to retained earnings, nothing more than just closing out the T account for that line entry.
I'm glad you asked that. So if we go back to the screen for a second, notice here, insurance expense, it says here, close to retained earnings. What the heck does that mean? What is Boylan doing to us now? What's this closed crap? Okay, one of the things that we talked about last time, if you come off the screen for a second, please. One of the things we talked about last time was the difference between the income statement and the balance sheet. And the way this thing works is the income statement is a flow across time. And it measures what went on from January 1st till when? December 31st. And it measures the flow of what variables? Revenue less expenses. And the key thing is that it measures from January. It doesn't include anything from last year, right? It only includes from January 1st till December 31st, these income statement accounts. Now, in order to ensure that these income statement accounts include this year's and only this year's information, what do we do at the end of every year? And the answer is we close all of these accounts. All of what accounts? All the revenue accounts and all the expense accounts. Now what does close mean? It means we bring the balance to what? To 0. So every expense account, every revenue account has to have a 0 beginning balance. Why? Because if it had a positive beginning balance, that would mean some of this flow was being carried over from the previous year. So what we do is we zero out, we close every one of those revenue accounts and every one of those expense accounts, and when we close it into what account? Retained earnings. In other words, we zero out the amount in the expense account, and then we adjust retained earnings at the end of the year for the amount in that account. And again, the key thing here to understand is why? Why do we close these things out? And the answer is because the income statement has to have a 0 beginning balance in order to measure what and only what transpired this period. If it had anything but a 0 balance, then there would be a legacy amount, and that legacy amount would make this period's income statement inaccurate because it was carrying something over from last year, or last week, or whatever the period in question was. Does that make sense? So this whole notion of closing the accounts is a very simple idea indeed. And that idea is simply that in order for the income statement to measure what it should, the flow during this particular period, it had to have a zero beginning balance, that expense account or that revenue account. And that revenue account then had to have what? A process at the end of the year where we close everything into this account called retained earnings. And you're going to see me do this. If it's a little bit hazy right now, you're right on schedule. Okay? Because you're going to see me talk about closing again and again and again. And in fact, next class, we're going to be reviewing the whole closing process. So we have a whole class, a whole session basically devoted to the adjusting process and then how do we actually close the books. What's the mechanics for how that happens? But again, the more important now is to understand why. And the rationale is because the income statement has a particular thing to measure. It has to have a zero. Those accounts have to have a zero beginning balance in order to measure that flow. Questions?
Would it be possible to open the door?
Is that an accounting question? It would, but not by me. You have to talk to someone else and open the door. I'm getting hot too, if that's any...
Thanks.
You bet. Okay. Next page. Next example. Now we're talking about fixed assets. And the picture is what we talked about before. We incur cost. We capitalize that cost into an asset. In this case, the asset's called what? Property, plant, or equipment. That asset then gets allocated, depreciated, using what we call straight line depreciation over some period to give us an expense per period, which is going to be our allocation process. Very simple algebra going on here. Questions? Okay. What is our formula for doing straight line depreciation? And the answer is we take the historical cost, and the historical cost is whatever we paid for it, subtract out our estimate of the salvage value, and our estimate almost always is 0, and then divide through by the useful life. Does that make sense, everybody? So again, very simple stuff here. If you come off the screen, I'm on page 2.8. On page 2.8, we're going to work through an example. And the example is we buy equipment and we buy it on account for a total cost of $113,000. 2, the estimated salvage value is $13,000. 3, we sell the equipment at the end of the 13th year for $13,000. So your mission, should you choose to accept it, is to create the journal entries that would be recorded by this firm to record all the information in example 2-4. And I'm going to do it in front of you here, and it appears on pages 8, 9, 10, whatever. But I'd like you to stay on this page and follow along with me, because watching the process, you have it written down for you, right? Watching the process for how it's done, I think has some value. Now, as I said before, we could create journal entries, but what I'm going to do is simply going to create T accounts for what's going on. So the first T account I'm going to create is a T account for property, plant, and equipment. P, P, and E. Although in this case, it's just equipment, but just so we get the general P, P, and E. Now, what type of an account is that? It's an asset account. Debits, increase, credits, decrease. That's right. Now, when we depreciate this account over time, what type of an account is that? It's an equity account called what? Depreciation expense. It's an equity account, therefore debits are decreases. The decreases to what? To equities in total. And credits are increases. So let's record the first, the part A, where we are purchasing equipment on account. And it turns out, in this example, we never pay for it. We just buy it on account and never pay for it. I'll stick our accounts payable over here, next to that handsome gentleman in the corner. Now, total accounts payable. What type of an account is accounts payable? Liability, therefore debits are decreases, credits are increases. So we buy this equipment on credit, and we debit what? We debit the asset PP&E for how much? 113, call it journal entry number 1. And we credit what? Accounts payable for how much? Call it journal entry number 1. Any questions about that? So again, you could write it out longhand as a journal entry, or you just use T accounts. Either way is fine by me. The end of the first year, we go to create our depreciation expense as an adjustment. Right? The transaction was to buy the equipment sometime during the year. And again, like we said, in this class, as far as I'm concerned, we're going to take a full year's depreciation just to make our algebra easier. How do we figure out depreciation expense? We take the historical cost, which is how much? 113. Subtract the salvage value, which is what? 13. Divide through by number of years, which is 10. What do we get? 10,000 per year, right? And again, the key is per year. So we go to record depreciation expense. What is our entry? It's going to be a debit to depreciation expense for how much? 10,000. Call it journal entry number 2. And the credit's going to be to what? Well, what are we doing? We're decreasing the net amount of property, plant, and equipment, right? So what we did last time was we credited property, plant, and equipment. Well, it turns out that's not what we really do in accounting. We create a separate account, and that separate account is called accumulated depreciation. And again, accumulated depreciation, which you will never know if I spelt it wrong because you can't read my writing. Accumulated depreciation is simply going to be the accumulated amount of depreciation expense over the life of this asset. So initially, accumulated depreciation at the end of the first year, right? Debit goes to depreciation, credit goes to accumulated depreciation. So we, now wait a second. What type of an account is accumulated depreciation? Okay. Nathan, what type? Excuse me?
Equity.
I didn't hear you.
Equity.
I still didn't hear you.
Let's try asset.
Asset. Right. It's an asset account. You're exactly right. I'm glad you're here. So, it's an asset account, but notice that this asset account has a credit balance. Now, most asset accounts have a debit balance. And this asset account is what we're going to call a contra asset account. And it's a contra account. Why? Because it has a balance contrary to what we would expect most asset accounts to have. Now, Bob, why in the world do we have something so convoluted? Should be your question at this point. And the answer is, well, the rationale is that what we do in accounting is we take the amount of the original equipment, then subtract out its accumulated depreciation. This was journal entry number 2. And so, what is net book value of the asset at the end of year 1? I'll put NBV, I'll put a sub 1 here for the end of year 1. What's net book value at the end of year 1? It's going to be 113 less the depreciation accumulated over its lifetime, which in this case was 1 year, or 103. That makes sense, everybody? In year 2, what entry do we make? Well, the first thing to remember is depreciation expense got closed to what? To retained earnings as of the end of the year, so the balance there would have been 0. The next year, we create an entry, called it entry number 3. The debit is to depreciation expense. The credit is to accumulated depreciation. Therefore, what's the net book value at the end of year 2? $93, right? 20,000 in accumulated depreciation. Questions about that? Jeff?
I think maybe I'm just confused, but why don't you take the net book value of the first year instead of 113 minus 20? Why wouldn't it be 103 minus 20?
Okay, because the net book value, you'd be double counting the first year's depreciation if you did that.
Okay.
Right?
All right. Okay. I see.
Right. Questions so far?
Could you just do 103 minus 10 instead
Yeah.
of adding the 2?
Would that give you 93?
Yeah. But I mean,
It's okay by me.
All right.
Question?
Are these different pieces of equipment kept separate
Yes, they are. So what, again, and
and then aggregated to a...
when I first started doing accounting, this kind of crap was a nightmare because you'd have file cards, one for each asset. You can imagine a place like General Electric that had 25,000 pieces of equipment at each plant, trying to keep track of each one of these things. And what would happen is every year you'd go to this thing, you'd find piece of equipment number 1155667, and you'd take the card out and you'd record this year's depreciation, and then net to the net book value on that particular asset. But of course that's dinosaur stories, and we'll come back to the present. And so right now it's all done by computer. But you keep track of every piece of equipment separately. And the reason is because if you go to sell that piece of equipment, then you know exactly what the book value is on that particular asset. Questions? So can you figure out what the rest of these entries are going to look like? Okay. 10, 10, 10, 10. Yeah, 10's a good number. Okay, we are now at the end of the year. The end of year 10. And what happens? We sell this piece of equipment for how much? $13,000. What is the net book value at the end of year 10? Total accumulated depreciation, dot, 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 is going to be how much? $100,000. Net book value is going to be what? The 113 historical cost less accumulated depreciation of 100. So net book value is going to be what? 13. This is net book value period 10. Right? And if we sell this thing for $13,000, what is our gain or our loss?
0.
And the answer is 0. Right? What entry do we make? In order to get, we sell it, therefore we have to do what? We take it off our books. What entry do we make?
We receive payment for $13,000.
Huh? Okay, so we receive cash for $13,000, and is that a debit or credit? We debit increase in asset called what? Cash. For how much? $13,000. Now what do we have to do?
Credit and asset.
We have to get rid of the asset, property, plant, and equipment. So we're going to decrease an asset account called PP&E. For how much? No. 113, right? Because that's what's in that asset account. Oh, let me go back and show you. What's in that asset account? 113. In order to get this thing off the books, we have to credit this for 113, which is what we just did right there, right? And these are debits here. These are credits. So we just credited, and the balance then went to what? 0, right? Which is the balance we want because we just sold that, right? Now, we have an entry doesn't balance. Doesn't balance at all. We have to, in other words, if we're taking off the asset, we have to take off its accumulated depreciation as well. The accumulated depreciation has what? Has a credit balance of 100. To get rid of it, what do we have to do? We have to debit it for 100 to bring the balance down to 0. So in this entry, we debit, we increase an asset, right? A contra asset, but we increase an asset called accumulated depreciation for 100, and lo and behold, our entry balances. Questions about that?
We're going to get into if we only say we sell, we only get $10,000 for it.
I'm glad you asked that. Suppose it's the end of year 6, right? And we sell this asset for $79,000. How do we record that transaction? That's not the question you asked, is it? But it will do for now. So ask that question again.
Wouldn't it be in similar matter? I mean, it's still cash goes up.
Okay. So we get cash. How much cash do we get? 79,000. That's easy enough, right? And what do we do? This is at the end of year 6, right?
You want to close out accumulated depreciation.
Close out accumulated depreciation. So how do we do that?
That's isn't that increase in asset by 60,000?
Okay, that's 60, right? Agreed.
You have to debit the asset.
We sold the asset. We got to get rid of the asset. Can we debit it or credit it?
Credit.
Credit it. We get rid of the asset. We credit an asset called what? PP&E for how much? 113. Entry doesn't balance. What do we do next?
Did you add money to your retained earnings?
No, money's cash, right?
Or
Add something to retained earnings. Let me ask you another question. What's the net book value of the asset?
60.
What is the net book value? It's 113 minus 60. How much is that? Oh, if we only had a calculator there, then oh my gosh. 53 is net book value. What did we get for it?
79.
We got 79. Now, are we better off or worse off because of that transaction? We're better off by how much? 26,000. What do we need to make this entry balance?
Profit.
26. What's that called? Profit or gain or equity. So we increase an equity account, a retained earnings account, and now I don't care what you call it, but what I would call it is gain on sale of property, plant, and equipment for 26. Does that make sense, everybody? So how do we get that gain? And now what we have now are two ways to do the calculation to make sure this makes sense, right? One way is to figure out what's the net book value. Then once you have the net book value, you compare the net book value to the amount that you got when you sold it, and you can have either a gain or a loss, right? If the amount you got was less than the net book value, it would be a loss. If the amount you get is greater than the net book value, it's a gain, right? Questions? So that's way number one. Way number two is to make sure your journal entry balances. Right? If your journal entry doesn't balance with that gain or loss, then something's smelly. And you need to go back and figure out what that smelly thing is. Questions? Last example before a break. So it is the end of year 4. And you sell this asset for $22,000. What journal entry do you make?
Cash asset.
Okay, we increase an asset called cash. For how much? 22. What is accumulated depreciation as of the end? What's the net book value? It is 113 minus 40. Oh my gosh. Next class, I'm going to bring a calculator. He's forcing me to think. 73? Okay. We sold it for 22. Therefore, our... Excuse me? 51 is our loss, right? So we have a loss here of 51. Now while I'm at it, I've made fun of you a couple times. My recommendation, in general, when you're in business meetings or when you're in this class, is to bring a little handheld calculator, because there's nothing as intuitive as being able to check on your little handheld calculator to make sure that whatever that bozo is saying, in fact, is correct and makes sense. And so and I've done it in many meetings, and then we'll go, excuse me, that's wrong. What you just said is flat out wrong. Let's try that again, because it doesn't add up. So, but that's just the accounting mentality, I guess. So we go to record this transaction. What does this look like? We pull off the accumulated depreciation. So we debit or increase an asset account. Remember, it's a contra asset account. Accumulated depreciation for how much? 40. Pull the equipment off the books. Decrease an asset called equipment, P&E for short, for 113. And now we need what? We need to record the loss of 51. How do we do that? Is it debit or credit? Debit. We decrease an equity account. It's a retained earnings type account called what? Loss on sale. Again, I don't really care what you call these things as long as they something reasonable. And here, 51 is added up. 7, yeah, adds up. Questions? Again, making sure this thing adds up. Make sure anytime you hand anything in to me, if you're doing a journal entry, make sure it adds up. Right? So this 113 looks good to me. Questions? Let's take a break. We'll come back in 6 minutes or so and move on to even more exciting stuff before we go home today. See you in 6.